It's not always simple to choose a dividend stock with a high yield and great quality. I like to take my time with each stock or ETF I consider, doing my own research on the company's financials, studying the industry, tracking the stock's long-term price performance and dividend payments, and so forth. I generally don't like what I see, and it happens rather regularly. There are a lot of high-yielding stocks available that gradually see a substantial fall in share price and dividend payments over time. In this video, we'll tackle a few high-yielding dividend stocks that I frequently hear income and dividend investors discuss, but that I personally don't prefer. So, if you're new here on Usable Wisdom, you came to the right channel, for we will surely help you kickstart your pursuit of great riches. Oh, and if you discovered something helpful from this video, it would be lovely if you subscribed. You can also unsubscribe at any point, but as long as you subscribe, you'll always be the first to hear about new money-making strategies as they become released. Hence, it is mutually beneficial. So, how about we keep going? Oxford Square Capital Corporation, or OXSQ, is the first company that I often hear people bring up that I don't particularly find interest in. They are a BDC, private equity and mezzanine firm based in Oxford that runs a closed-end, non-diversified management investment company and invests in both public and private companies. They also invest in common stock, preferred stock, junior subordinate debt, secured and unsecured debt, and syndicated bank loans. From a surface-level perspective, this stock seems to have a lot of positive aspects. You can see that it delivers a substantial dividend yield of around 10% straight away. In addition, the stock is extremely inexpensive, trading for about $4.24 per share, making it almost a penny stock. Additionally, the stock page pays dividends every month rather than quarterly. Even while it may not have much of an impact on how your investment compounds, receiving payments on a monthly basis is always more gratifying. However, as we go further into Oxford Square's past, we start to uncover a number of truly repulsive aspects of this business. One of the reasons is that its stock price has dropped more than 71% since its introduction in January of 2004. Its payout history also demonstrates a consistent decrease in the number of dividends that they pay. It is currently down more than 10% over the past year, and down more than 42% in just the last 5 years. Since 2012, Oxford Square has increased its dividend, and since that time, it has only decreased. In fact, in only the previous 2 years, their payouts have nearly been cut in half. Looking at their investment portfolio on its whole reveals several aspects of BDCs that I usually don't like. When compared to other business development companies, Oxford Square is a relatively tiny organization and has a substantially lower level of diversification. I would consider Owl Rock Capital Corporation as an alternative. Despite having one of the greatest investment portfolios available, it doesn't offer a dividend yield quite as high as Oxford, and pays dividends quarterly rather than monthly. Looking at their balance sheet also reveals that they are now undervalued, which is also great. The following stock that I advise investors to steer clear of is ARMOUR Residential REIT, or ARR. In the US, ARMOUR makes investments in securities secured by residential mortgages. The majority of the securities in the company's portfolio are issued or guaranteed by the government-sponsored entities, or GSEs, of the United States and the National Mortgage Association. ARMOUR also invests in other securities backed by residential mortgages, for which a GSE or other government body does not guarantee the payment of principal or interest. But now let's take a closer look at some fairly alarming aspects of this stock. The share price of ARMOUR has decreased considerably, much like Oxford. The stock has lost an astounding 88.44% of its value since its 2007 inception. Previously trading at around $80 per share, it is now only worth $8.40 per share. For the previous 12 years, they have cut the number of dividends paid practically every year. ARR paid 96 cents per share per month in dividends in 2011, but presently only pays 10 cents per share, which represents an extremely sharp fall over time. There just isn't a company out there that I'd suggest in place of ARMOUR that delivers a dividend yield of 14%. It will be difficult to top. However, there are mortgage rates that offer far higher returns than ARMOUR Residential. Starwood Property Trust is an example of equity with a long track record of performance and a dividend yield of around 8%. The stock has a successful track record, and its share price has increased by more than 53% since its 2009 launch. The following stock is Annaly Capital Management, or NLY. The largest mortgage lender in the US is Annaly, one of the first M-REITs to be publicly listed in 1996. Annaly is a diversified capital management with interest in corporate middle market lending and housing finance. The company makes investments in agency residential mortgage assets, mortgage servicing rights, agency commercial mortgage assets, and agency mortgage-backed securities. Annaly isn't as horrible as the other equities we've examined thus far, in my opinion, but it has struggled a lot over the past few years. With a share price of just $7.03 and a dividend yield of 2.46%, this company is quite affordable. As I already indicated, Annaly is one of the largest mortgage REITs available, with total assets of over $89 billion. Since becoming public, they have distributed over $22 billion in dividends to stockholders. Using a dividend reinvestment calculator, we can see that if you were fortunate enough to buy in an elite back in 1997, you would have gotten a respectable return. Their website also claims a 925% total return since their IPO. Annaly was a much better performer back in the day. Their stock remained in a stable range between 1997 and 2013, typically between $10 and $20 a share. However, Annaly's fortunes began to change in 2013, and since then, their performance hasn't been all that strong. The price of Annaly stock has decreased by more than 65% over the past 10 years, and it has dropped by about 20% just in the past year. Additionally, they haven't increased their dividend in almost a decade. As I previously stated, Annaly is likely the greatest on this list, but I don't see any justification for recommending them at this time, even though I do wish them better times to come. Before we continue, please feel free to comment with suggestions below if there is any topic in particular you want us to discuss in the future. With that said, let's get back to the content, shall we? Ares Commercial Real Estate Corporation, or ACRE, is probably my favorite mortgage REIT, and I would suggest checking it out instead. Although they do not, however, provide a relatively similar high dividend yield, ACRE hasn't reduced its dividend since its IPO in 2013. Ares Commercial Real Estate currently has a dividend yield of 8.39%. Orchid Island Capital, or ORC, is another really popular stock that I'm not really fond of. Orchid is a specialized finance firm that invests in residential mortgage-backed securities, sometimes referred to as agency RMBSs, which are backed by single-family residential mortgage loans. Their portfolio consists of principal-only securities, interest-only securities, and inverted interest-only securities, as well as conventional pass-through agency RMBSs, including mortgage pass-through certificates and collateralized mortgage obligations. It is simple to understand why this company is so appealing to dividend investors, given that, according to Yahoo Finance, it yields a dividend of 16.62%. It pays dividends every single month, just like ARMOUR and Oxford Square, and offers one of the highest dividend yields conceivable for a stock. At just $3.26 per share, it is incredibly affordable, and it currently distributes a dividend to stockholders of 4.5 cents per share each month. This indicates that if you invested $1,000 today, you would receive dividends of $13.70 every month for the rest of your life. However, you should first look at how much Orchid Island has failed throughout the years before investing any money in it. Since their IPO, the value of their stock has decreased by roughly 78%. Previously, it was trading all the way up at $15 per share, but it is currently trading for $3.26 per share now. Even after accounting for all the dividends you would have received over time, you would still be in the negative. You can see that even if you reinvested dividends, you would still be down roughly 7% if you had purchased shares when the stock had its IPO. If I were to suggest a better choice than Orchid, I'd have to go with Ready Capital Corporation, or RC. Again, its dividend is not even near to Orchid's, but it is much more stable than Orchid's, whose payout is practically constantly being cut. And that concludes a few of the popular high-yielding dividend companies I often hear others talking about, but don't myself find compelling. But then again, you are always free to form your judgments. And if you invested in these stocks at the right moment and were successful, that's fantastic. However, I won't be promoting these firms in the near future. It's always worth remembering though that prior to investing in any company, be sure to conduct your own research and due diligence. You should also broaden your investment portfolio diversification in order to minimize your risk exposure. Thank you for watching. Hopefully this has been an enlightening experience for you. And if you want to see more content like this, subscribe now and hit the notification bell so you'll be one of the first to see our latest uploads. See you in the next one.